Hello everybody, thank you for watching. Wanted to do a real quick video on what I do as far as options trading inside of the Velocity portfolio. I've hinted at it in the past, but I wanted to dive into it and show some bullet points of what I actually do. To the new viewers real quick, listening or watching to my channel, wanted to do a quick overview of the strategy of the Velocity portfolio. Number one, deposit $6,000 per month into the account. Typically, I do this every Friday. So if there's 4 Fridays in the month, it'll be $1,500 each Friday. If there's 5 Fridays, then I break it out accordingly. If there is any overage, I also deposit that into the account above the $6,000. Secondly, 50% of this money that is invested in or deposited into the account is used for options trading specifically, which is what I'm going to touch on in this video. How do I go about this options trading? Third, 50% is used to purchase high yield dividend stocks and ETFs, which I've gone over in previous videos and shown some of the tracking for that as well. And I'll dive deeper into that as more videos come out. Number four, on the first of the month or a little bit before the first of the month, I transfer $6,000 withdrawn on margin or borrowed on margin to my regular checking account. I use that to pay my mortgage and my student loans. So right now, those two things are paid for by margin, and the money is borrowed on margin. Fifth, all income generated from options trading or from dividends is used to pay down the margin balance over time. And then eventually the income generated will outpace the margin borrowed. That is, the money that's being generated from options trading and from dividends will be above or more than the $6,000 that I am withdrawing to pay the mortgage and student loans. Going into what I do for the options trading in my account. So the main goal of the options trading, like I mentioned, is to create income to pay down the margin balance, just like the high yield dividend income or any stock income or even capital gains. If I decided to maybe try swing trade a stock because I bought it was beaten down, from earnings or something like that. Anything that's generated from income that is generated from any of these tactics is used to pay down the margin balance. So first step is to sell puts approximately 7 days to expiration at around the 20 delta, roughly is what I shoot for. I will go lower depending on how I feel about the individual security I'm looking at, but typically I shoot for that 20 delta. Secondly, once I've done that, I immediately set a good till cancel order to buy it back for $1 per contract. And I do that for all of these positions. What that does is gives me an out in case something were to happen where it suddenly shoots up and it's able to close well before the Friday expiration date. And then when I see that pop up on my phone, I can immediately jump in there and sell another one. And I get more days to expiration because of that. Third, if it's not bought back immediately or automatically by this good till cancel order, then I will roll or take assignment depending on what it looks like on Friday. I do check the account periodically throughout the day, throughout the week, a few times a day throughout the week. And if I see an opportunity to close it for half the price and sell another or jump into a different stock or ETF, then I will do so. But generally speaking, I will manage it the following Friday, and then I roll it if it is under my strike price, or I'll take assignment and decide to start selling calls. Number four, I look for stocks and ETFs that are near 52-week lows. Most recently, I've been selling puts on Starbucks. It's pretty low compared to its 52-week low. And then when Target had a bad earnings report a few weeks ago, or I think it was actually a couple months ago now, I was selling puts on it as well because it was so low. I think it was sitting around $90 a share. So I immediately started selling puts on it. And so far that worked out. I didn't get a sign. I've just been collecting premium from it. 5, I look for stocks and ETFs with high implied volatility. So These are easy to jump on because the higher the implied volatility, the more premium you're going to get from selling. So it's hard not to just jump into all of these, but I try to keep a mix of what I think is safer, finding stocks and ETFs near their 52-week lows, and some with some high implied volatility to generate some more income. So stuff like TSLL or SOXL are pretty popular. TSLL follows, it's a double or triple leveraged Tesla ETF. So the implied volatility is kind of inherently high on it because Tesla is always high. So that is for selling puts. If I get assigned on any of those puts, I will immediately sell calls above the cost basis to capture capital gains if possible. This isn't as common because if I get assigned, it's typically because I was not able to roll for a decent credit. And when that happens, if you're not able to roll for a decent credit and then you take assignment, you're probably a little bit below your strike price. So selling above the cost basis may not be worth the squeeze, or it's just not enough to really sell the call in the first place, and you might just go to your cost basis and get out of it. Along with that, selling calls at the cost basis to have it called away or get so you can get back to puts. So my goal is to constantly sell puts. If I do get assigned or have to take assigned on a position, then I'll immediately sell calls to try and get out of it. So I'm going to sell it at my cost basis. So if my cost basis is $50, I want to sell it at 50. Or worst case scenario, if it goes down quite a bit, I'll sell it at 49. That way I can try to roll once to get up to the $50 strike price. But typically I'm selling at the cost basis or above. If the price is well below the cost basis, like I mentioned earlier, I will hold and sell very conservatively. So I might sell covered calls at like a 5 or 10 delta just to collect a little bit of premium while I wait for the price to come back up. Or if I don't even want to bother with that, I will just purchase more shares to lower the cost basis and just wait for it to come back up without even selling calls. So notes on this, I only use stocks and ETFs I'm comfortable holding for a long period of time because, like mentioned here, this can happen, and it does happen. If you were selling puts back in April when everything dropped substantially, matter of fact, I'm still managing a position from that point that I've been collecting premium on for by selling covered calls. You can be sitting on these things for quite a while, sometimes 6 months, 8 months, depending on how far below you were and how bad the drop was. And there always seems to be a reason for a big drop lately. Since 2020, the market's been just kind of crazy. So I use a tracker to keep track of my net cost basis to get out of a position earlier if need be. So that is, I sell puts, and if I go back and look at the puts I've sold, I can take the premium. If I really want to get out of a position, I can take the premium that I've generated from that for the last how much ever time I want. It could be weeks or months. Say I generated $200 in premium from selling puts. I can use that to lower my cost basis for my now assigned position and sell calls at that number rather than the original strike, just to get out of the position at a break even. I'll only do that if I'm kind of desperate, which is rare because I'm selling options on things I'm comfortable holding for a longer period of time. That being said, if it's been 6, 8, 10, 12 months, whatever the case might be, I might just be done with it, and I either want to take it for a loss or use this net cost basis. But I'll pretty much try to sell at the strike price. That way I can capture some sort of premium, or sorry, not premium, some sort of profit in addition to the premium that I've collected from selling calls and puts. So I just wanted to quickly run through what I'm doing with the option strategy in the portfolio. So now I've covered the 50% of money that I'd use for options and 50% of the money that I use for high yield ETFs and stocks. I will have another video coming out on Thursday or Friday this week going over the monthly recap for July, since the 1st of August is on Friday. So look for that one to come out shortly, and thank you for listening.